Hello.
Hello, Stephen. How are you?
Good, Dudu. How are you?
Great. We're about to go now.
Good. Good to hear that. Still in your new studios.
Yes, but you are live on Facebook already.
Sorry.
I said we are live on Facebook already. Ah, no, not Facebook, YouTube.
Hello, everybody.
How's it, Alec? My Riverside isn't working.
Oh, dear. Oh,
This is a first.
Well, we can phone. Hi, Stephen.
Hi, Alec.
I can hear you.
How are you doing?
Was there a bit of a worry there? Riverside not working?
No, my Riverside isn't
yours.
working. No, Stevens is working perfectly.
Justin just gave me a little, not a heart attack, but something like. Sorry, I just need to go and get my pen, and then we got to go.
Yeah, I know. Anyway, Stephen, how you doing?
I'm good, thanks. Yourself?
Yeah, Lackerman, not too bad, thank you.
Good. So, Justin, is it the original lineup plus this old mutual question?
Yeah, so I think the old mutual question you and Alec will discuss, and then unfortunately Morna had to drop out last minute. He's got budgeting until late. But Magda's going to chat about the Cathy Wood Fund to start up with, and then we'll still be touching on a bit of high proper, Alec, and then we've got someone, Adamus Stemmet, to chat about the pension funds thing.
Okay. Existential crisis. Okay. We need promotions. No. We need social. Yes. YouTube.
I'm going to try again quickly.
Aha. There we have it. Hello, everybody on YouTube. I can see you now that you've come through. Remember, down here, I'll just put it on there. Here is, where you post questions, please. And Lorata, if you're listening, we have got your question from last night, which we are going to give to both Stephen Nathan and to Magda Wierzycka. So you're going to have 2 for the price of 1. I think it's good if you, I don't know why I'm looking down there, because I'm looking there because that's where the YouTube is, but I'll look here. It's good if you do try and get your questions in early, please. And we'll just see the glamours here. There's the glamour. And the other glamour.
Yeah, Riverside's not working for me.
Riverside's not working for you. That's okay. Okay. So are we ready to rock and roll? Okay, let's hit it.
Stand by. Business Power Hour starts in 25 seconds. 15 seconds. 10 seconds.
The BizNews Power Hour.
Welcome to the BizNews Power Hour, where we give you the rational perspective on business news that matters. Indeed, we do. And tonight, our guest co-host is Stephen Nathan. Stephen, the kid's not listening to Netflix this week, I hope.
Let's hope so. I've banned them for this hour at least.
Shame. I hope that you don't put, you don't tell them that you have to come and help us out here. So we do need the bandwidth so that we can at least hear you. But I'm sure we won't have the same issues as last week. It's been interesting to see the tech shares, which sold quite aggressively yesterday in the United States. It seems to have stabilized now. I see the NASDAQ is down 0.4%. So a little bit of panic, and it was only a little bit, only down 2.5%, might be over for now.
Yes, I think, Alec, one's always got to look at these things in the context, coming down 10, 20, and 35% in some cases. Obviously, that is a big move, but you're really seeing a very short-term period. We're looking at, a couple of weeks, and the tech sector has done incredibly well off a very high base over the last 12 to 18 months. I think we've got to be sensitive to that. And we also know that financial markets tend to overreact in the short run. So if there's a hint of inflation and a hint of rising rates, then that gets, if you've benefited from very low rates because your earnings into the future are worth so much more, then you are going to get something on the downside when that goes against your favor. But it's still very early to tell whether this is a long-term correction or just a short-term blip in an otherwise very strong upward trend for tech shares.
Well, we're going to have lots of discussion on that subject with both you and Magda Wierzycka will be joining us in a little while. Magda is the founder of Sygnia. Lots to talk to Magda about, isn't there, Justin?
Yeah, tons, Alec. Sygnia also releasing an emerging market ETF, which I think comes to the market in June or July. It'll be targeting 5 countries in the East, what they've discovered as areas of growth. So it'll be great to chat to her about that. Also, Sygnia's money market funds, as a result of Absa's, they've lowered their fees to 0% until 2022. And then
as a result of Absa's moving out of there, 85
I
billion.
don't know what to call it.
Well, it might have called, you might call it the CEO killer, because the CEO of Absa resigned or departed or
exactly
was fired very shortly afterwards. Yeah.
And then the Vacutech IPO, which is a spin-off out of the Sygnia OSI fund, which they've invested in through Oxford.
Yeah, that's an interesting one as well. So there's lots to talk to Magda about. And then at the top of the hour, we are chatting with Adamus Stemmet. He's the spokesperson for the pensioners, government pensioners, who have got their pensions in the PIC and are very unhappy about the way the PIC has been handling their money. Today, we had a cracking story on Bloomberg where the unlisted fund that the PRC has. It's a couple of billion rand in there. The staff there are very unhappy and have written a 9-page letter. Existential crisis, they call it.
Yeah, no, very concerning. I think we've joked about it on the program in previous throughout the previous weeks about the PIC generally buying at the top and selling at the bottom. So it'll be great to chat to Adamus and sort of unpack what's been happening there in the last few weeks, because at the end of the day, this is pensioners' money and money that can't go to waste.
We'll also hear from him, no doubt, about what he thinks about Iqbal's surveys, 4 billion rand that he's got from the PRC, which is actually from government pensioners and is not wanting to give back. I know Adamus has been incredibly outspoken about that. Also tonight, we are going to hear why degreeless jobs, people like me, went to university 1 year. But I don't feel too bad about that, because Steve Jobs also he only went for 6 months. Bill Gates went for a year. Zuckerberg only went for a little period of time. He didn't pass. So I don't feel too bad to be in that kind of company. Anyway, people like me without degrees are in demand in the United States. Maybe there's hope. We'll hear more about that from Bloomberg, and we will also be hearing from Treasury One, Andre Celia, who will bring us up to date on the rand.
Plans are afoot by the South African Revenue Service to address tax avoidance in the country's minibus taxi industry, which only paid 5 million rand in taxes last year. Finance Minister Tito Mboweni said in a parliamentary response that tax avoidance is across the tax ecosystem. South African miner Harmony Gold has reported a jump in third quarter core profit. Firmer bullion prices have helped miners' profits soar despite the COVID-19 pandemic, with the company receiving a 16% higher average gold price during the quarter of about $1,708 per ounce. The rand extended its rally on Tuesday. Its 30% gain against the dollar since the height of the pandemic has outstripped emerging market peers. Analysts say that strong commodity prices and the global search for yield should support the narrative for further gains in coming months. Senior employees at a unit of South Africa's Public Investment Corporation have accused executives at the continent's biggest fund manager of causing an existential crisis after a series of scandals over the past few years. Staff at the Isibaya Fund, which oversees unlisted assets at the $136 billion PIC, submitted a list of complaints, including a failure to renew a mandate with the division's biggest client and allegations of general poor management. New information has emerged about the divorce of the billionaire Gates couple, with the Wall Street Journal reporting that Melinda Gates was meeting with divorce lawyers since 2019 to end the marriage with Bill Gates. The philanthropist had discussions with lawyers in October 2019, around when the Microsoft co-founder's ties to Jeffrey Epstein became public. According to documents reviewed by the journal, Ms. Gates and her advisors held a number of calls in October 2019, when the New York Times reported that Mr. Gates had met with Mr. Epstein on numerous occasions. Gates once stayed late into the night at Epstein's Manhattan townhouse, the Times reported. Epstein died in jail in August 2019, awaiting trial on federal charges related to sex trafficking. In early 2020, the Gates couple surprised many people when they said they would not attend the World Economic Forum in Davos. By that time, the Gateses were already in discussions to divide their vast wealth. For more on that story, do go to BizNews Premium, where you have full access to the Wall Street Journal. I'm Jackie Cameron for BizNews. For more on those and the other big stories of the day, visit biznewsradio.com.
That's an ugly, ugly story. Bill Gates being close to Jeffrey Epstein. It's the one person, Stephen Nathan, you don't want to be associated with in the world right now. Epstein's, all the stuff that's coming out about Epstein is horrific. And now Gates it was there late in the night. Oh, my word.
Yeah, it's certainly not someone who you would associate Epstein with. Bill Gates, as we know, he certainly is more in the camp of hanging around those type of cerebral people and not looking at the limelight. So that is very, very unfortunate and a bit concerning as well.
It was interesting, though, when everything broke about Epstein, all the sex scandals and the way that he made his money that nobody really knew how, there was a lot of suggestions that much had not been disclosed. And, of course, now with Melinda Gates, clearly a woman scorned. Anyway, we'll be following that story pretty closely.
There's a good book there.
There's more than one, I'm sure, Stephen. BrightRock believes that with every change in life comes opportunity, and the markets aren't any different. The daily movements in the markets means change for us all, sometimes small, sometimes big. This daily market report is made just for you by BrightRock, the first ever needs-matched life insurance that changes as your life changes. Here's Justin.
The JSE All Share Index was a bloodbath today, sharply low at 67,300. Naspers down 2.3% to 3,115 Rand a share as Tencent was weak in Hong Kong this morning. Prosus down 3.3% to a touch over 1,400 Rand a share. The share is nearly 30% off its highs and deep into bear market territory. Vroneman Sybanya Stillwater lost 4% to 65 Rand a share as the positive Q1 update is simply a distant memory. Harmony Gold shed 5.5% to 68 Rand a share as even safe haven commodities were sold off today. And Hyprop lost 5% to 28 Rand as the company announced an accelerated book build, which raised approximately 360 million Rand. In the currency markets, the Rand was flat against all the major currencies to 14 Rand to the dollar, 19 Rand 80 to the pound, and 17 Rand 03 to the euro. Gold is steady at $1,829 an ounce. Brent crude is flat at $68.40 a barrel. And the premier cryptocurrency will put you back 780,000 Rand a Bitcoin.
And that Hyprop story?
Very interesting. They announced an accelerated book build, which was oversubscribed. Java were the book runners, who I know also their sponsors. Yeah, they're cash strapped. They didn't sell their Nigerian mall. That sale went through. It was promised. I think that's what kept the share price pumped up. And quite honestly, opportunistic of them to do this book build at the share price. I mean, I think if that Nigerian sale was off the table from the beginning of the year, the share price wouldn't be near $30.
We were hoping to speak with Morné Wilkin, but he's busy.
He's in budgeting. The irony here, Stephen, if they had budgeted properly, they wouldn't have had to raise capital today, huh?
So I think it's not so much about the budgeting as being opportunistic. I think you're exactly right. You know, when capital markets are strong, if you can imagine being in their shoes 12 months ago, you know, with lockdown, retail, you know, heavily involved in retail, your tenant arrears, you know, you were almost looking like, you know, bankruptcy was a potential scenario. Now you've been given a lifeline with capital markets really strong. As you said, the share price up like over 60% in the last 12 months. So it's actually a prudent, responsible thing to do, just to protect the business and ensure you can get through, you know, lockdown and strengthen the balance sheet.
This market report was made for you, just for you, by BrightRock, the first ever needs-matched life insurance that changes as your life changes. You're listening to the BizNews Power Hour, brought to you by the team at biznews.com. Magda Wierzycka is the founder of Sygnia, and she joins us now. Magda, we've got a pile of questions to put to you, but I'm going to start with Paul Jeffries, who's on our live YouTube chat. Well, live chat on YouTube. We've got a virtual studio going on here, which comes through on YouTube, and we get quite a few people, members of our community, who tune in there. And Paul wants to know. He says, "Please ask Magda to shed some light on her Fourth Industrial Revolution fund's performance. Seems to have started declining from the Section 28 retractment that she and Magnus were so positive about, and then continued down."
Alec, thanks for having me. I think, you know, the Sygnia Fourth Industrial Revolution Fund tracks, you know, Disruptive Innovation Index, which really invests, you know, in sectors such as electrical vehicles, autonomous tech, genomics, you know, all these kind of futuristic trends. And, you know, all of those companies, I mean, the fund itself holds over 380 different companies. So it's a very well diversified fund. And, you know, no single holding exceeds, I think, 3% of the fund. And it had a very, very strong run last year. So it returned over 80% return, and that's in dollar terms. What we have seen this year is, you know, January, we still had a bit of a market upside. And then since kind of, you know, end of January through February and March and going on, we have seen equity markets retreat, and that retreat has been, largely a function of fear of inflation, resurgence of COVID, shortage of vaccines worldwide. So all these kind of big picture macro factors. And, in that retreat, the technology stocks in particular have been, hurt harder than, some of the other bellwether type companies, and certainly harder than, commodity stocks, which actually have benefited. And consequently, that is what you have seen in the performance of the Sygnia Fourth Industrial Revolution Fund. And I think, the reality is twofold. One is whenever you've had such an exuberance in a sector, you must expect some trending downwards, and you have to expect that, some of the froth will come off. But when one actually looks at the underlying approach of the fund and what it invests in, it's still the fund that I would put most of my money into, apart from Sygnia. Oxford Science Innovation Fund, of course.
It's really interesting to compare you with Cathy Wood's ARC Innovation Fund, because in most people's perception, they're similar. However, the ARC Innovation Fund is down 35% from the peak in February, whereas yours is down 16%. So relatively speaking, and not so bad. However, Cathy seems to be in a different area. She doubled down in the past week, buying R1 billion worth of Twitter shares, and then went big into Coinbase, which actually worked out for her at that time. I heard her being described as a conviction investor. Would you say that her convictions are going to get her into trouble, or is this the new Warren Buffett?
So it's interesting that you ask, and maybe, I shouldn't talk too much, but, I always do. My next plan, let's see how it works out, is to actually take on ARC in the international markets, but doing what they do, thematic investing in the futuristic trends or disruptive technologies, but on a passive basis. So what Cathy Woods does is, she ran the ARC Innovation ETF is very similar in terms of philosophy and objectives as Sygnia Fourth Industrial Revolution Fund. However, it only has 58 shares. And, it might not surprise you to know that the top 3 shares in that ETF or in that fund constitute over 20% of the portfolio. So her largest holding is Tesla, which is almost 11% of the fund. So when you look at that kind of and the other 2 are Teladoc Health and Roku. So when you look at such a concentrated, active positioning in few counters, you can literally see the tail wagging the dog. Because it's an unbalanced portfolio. And, the approach that Cathy Woods has taken is to manage this kind of, disruptive innovation theme on an active basis. Whereas, I believe that a much more sensible approach to investing, and I do believe that everyone should, as part of a balanced portfolio, invest in the future, and into companies that have the are not the sunset industries, are the sunrise industries. But one needs to do that in a very diversified manner, which is, what Sygnia Fourth Industrial Revolution can achieve. Whereas, when you start taking very large bets on individual companies in that disruptive space, you are bound to run into trouble and experience much greater volatility of returns than, well-diversified portfolio.
Our guest co-host, Stephen Nathan, knows all about fund management and this area. As you know, he was the founder of 10X. And that's an interesting international target that you've put on Cathy Wood's back. Stephen, do you think that Magda is going to go and take her out, or at least be successful in this passive versus active in probably the hottest sector in the world right now?
Yeah, so I think it's very interesting what Magda is saying, and I definitely agree with her from the fact that when you have a portfolio, if you've got a high conviction portfolio, then clearly if you get it right, you're going to do much better than the index. But if you get it wrong, you're going to do much worse. So you're almost making 2 decisions. The one is, should I be investing in disruptive technology? how much of my money should I put there? And that's, that's quite a challenging question for a lot of people to answer, because, clearly you want to be part of the future, as Magda said, but also, it's not without risk, and a lot of these companies are highly valued. So when you do that into a high conviction fund, I think you're adding an element of risk on risk. And I certainly prefer, Magda's approach of holding many more shares and being far more diversified, because it's very difficult to winner when the technology is so fluid. Nobody knows who the winners are going to be. That's part of the excitement. It's part of the interest. So when you're taking these really high conviction bets, I think that's probably too much risk. So I wish Magda all the very best.
Well, you've got a vote then from Stephen Nathan, Magda, on that one. We had a question last night from Lorata, which we couldn't get round to on our YouTube channel. And she asked whether, it'd be interesting to get your response to this, Kathy Wood's ARC funds can make a comeback. Is it a good time to buy?
I think, she will make a comeback. I've got no doubt about it. But I think it will be a very volatile ride. So I think, you will have 20% up, 20% down, maybe, 15% up, 25% down, because at the end of the day, you really are placing a reliance on few shares in that portfolio. The fact that there are 58 shares is largely irrelevant, because, anything below kind of, 30, so the 58 shares, anything below 30 is less than 1% of the portfolio. And many of her other positions are kind of, I'm looking at the portfolio right now, so I'm not guessing. Many of her positions are in this kind of 1.2, 1.3% range. So immaterial to the actual performance of the fund. So you really have to look at her top 10 holdings, where most of the fund is positioned, and Coinbase is part of it. So is Spotify, so is Zoom, so is Square, which is a very exciting company. But, the biggest position really is Tesla. And, if you believe that those companies are the companies of the future and will recover from where, she's dropped, then yes, but just know what you're investing in. You're investing in those 10 companies. You're not investing in a well-diversified portfolio.
Let's move on, or move backwards a little, because it really was a seismic shock when Absa decided to close its 85 billion rand money market fund. We criticized it loudly on this program on the view that they were not going to be successful in getting people who invested in money market funds to switch into bank deposits. And we know subsequent to that, the CEO has left, resigned, fired, call it what you will, but he might well have been a victim of that decision. From your side, though, you've had an interesting reaction. You've seen this as a market opportunity at Sygnia.
Okay, it's always a market opportunity. So I think, what Absa is relying on in terms of moving, because I think the move is automatic unless you opt out. So they're relying on the fact that a lot of the investors in the money market fund either won't be able to tell the difference or won't care particularly whether they are invested in a money market unit trust or whether they invest in a in a bank account. Of course, the move does provide a little bit of a cynic, but I think it does provide Absa with much greater lending capacity, having the money on the balance sheet instead of in the unit trust. It was a very smart business move. I think it's absolutely independent of Daniel's move, and resignation from the position of CEO. And knowing Absa a little bit, I didn't find it. I found it very disappointing, because I actually know him personally, and he's a super smart guy. But I think what he encountered is, a clash of cultures of many years in the making. So I think, Maria Ramos was the type of leader who led on a very decentralized basis. So she allowed, divisions of Absa to operate as separate businesses with their own pseudo CEOs in place. And then, of course, there was this huge gap when they were looking for a new CEO until Daniel stepped in. And he, what I know of him, he has a very centralized style of leadership. So he would have wanted to be very hands-on involved in each and every one of these businesses. And of course, he found resistance. Absa is a very large business, and he found resistance. And, it was that, I mean, call it clash or misalignment. And I guess, the board of directors had to make a decision as to, which way they go. But I find it very, very disappointing that he has left Absa. I think he should have given it a much longer go and a harder try.
Magda, everyone's excited for the new Sygnia Emerging Market Fund launching soon, focusing on 5 different regions in the East. Can you just unpack that ETF in greater detail for us?
So, we've long recognized that, South Africa is just one of many emerging markets. And, we tend to talk about emerging markets as if they were, all the same. And certainly there is some behavior of international investors, such as, switch into emerging markets, switch out of emerging markets. And that is typically driven by the cost of borrowing and, higher yields offered by emerging markets. But the actual fundamentals of emerging markets, such as, India versus Malaysia versus Brazil versus South Africa, for that matter, which is very small, are very, very different. And consequently, the exposure that you're buying is a very diversified exposure, as opposed to just, the South African specific exposure, which, frankly, if you look at the JSE, it's all about commodities these days. So, our view is that, again, in a well-balanced portfolio, if you want diversification, it's not enough to buy the MSCI World Index, because if you look at the composition of the MSCI World Index, US is, I think 48% of that index. So you really are buying kind of half of US, and then the rest of the world is kind of on the fringes. So, a much better way of structuring your portfolio is to look at developed markets, or in fact, geographical locations as far as developed markets are concerned, because I would certainly, overweight China and US relative to, some of the others, relative to Europe. But then you look at, emerging markets, and you certainly should have a higher allocation to emerging markets than what you can achieve through a broadly diversified, MSCI World Index benchmarked fund. And hence we do believe that, we need to start launching more building blocks for our investors. So emerging markets fund is one. China fund is coming next. And then we will look at some of the thematic fourth industrial revolution type ETFs as well.
That's interesting. Before we let you go, the Vacutech IPO, you did mention earlier, those who aren't aware of it, it's where the Oxford University COVID-19 vaccine, the IP sits. What's the progression on that side, and what would it mean for Sygnia investors?
Alex, so the Vacutech owns the, part of the IP, because part of it is owned by Oxford University, part of the IP behind, as you said, the AstraZeneca vaccine. And it's the first of the OSI, Oxford Science Innovations companies to actually IPO. And, what is exciting about it is that obviously in terms of the value at which it is carried on in books of, OSI or the balance sheet of OSI, it's much lower than what it IPO'd at. The question mark to me about the Vacutech IPO, and many, and there are many more Vacutech type sized opportunities and spin-out companies in the OSI portfolio. My question mark always from a commercial perspective is how many of these companies are really ready for an IPO. And, Vacutech decided, and obviously there's an independent board of directors which sits underneath the OSI board where, where we do have representation. So they decided to IPO, but they IPO'd, against the background of obviously AstraZeneca, and I think very unfairly so, has come under some, horrendous PR. They are now fighting back. And so, given that AstraZeneca has, just slightly lower efficacy than Pfizer's and Moderna's, there is absolutely no reason why, it has come under the bad press that it has come under, other than lack of responsive PR from the company itself. So I actually blame AstraZeneca. But also it's the only vaccine that is being sold at cost. So, that hasn't kind of been appreciated by investors. But Vacutech itself, listed against the background of all of that AstraZeneca noise. And, if it was up to me, I would have waited. So AstraZeneca, for instance, is currently applying for full approval, not emergency approval with FDA. If that is granted, Vacutech will benefit hugely from that. So I think it's, the Vacutech IPO is proof of concept. That is Oxford Science innovation, and the concept is that you can commercialize world's leading IP and turn it into world's leading companies, which deserve to be highlighted and in the public markets as opposed to private space. So on one hand, the IPO itself probably disappointed some investors, happened against horrendous market background, but it definitely is proof of concept. And I think in the next couple of years you will see more OSI companies IPOing internationally. So we're very excited over the fact that this is starting to happen.
Last question comes again from our YouTube channel. Ray Walpe wants to know, does Magda believe Square's share price is currently overvalued? You did mention it a moment ago as one of Kathy Wood's top holdings.
I think, if you want my honest opinion, I think everything in her top 10 holdings is overvalued, purely because, ARC has attracted so much money last year, and they have thrown that money at these top 10 shares. They have driven up, and then what they do as part of their marketing, they make all of their positioning, all the investments that they make it public. They write newsletters about it. And what has happened in the US in particular is that there has been, through COVID, pandemic and lockdowns, emergence of the retail investor. So suddenly you have platforms like Robinhood with, young people sitting at home and day trading. And they listen to the commentary and narratives coming out of ARC, and they buy the same positions. So they drive up those share prices indiscriminately without knowing what they're doing.
So watch out for Square. It could be not so good, not such a Square deal.
Well, I think it's a fantastic company. So when you actually unpack what Square does, which is, it takes, point of sale devices to a brand new level, driven by machine learning, driven by, feeding back to merchants. I mean, it's an incredible company to research with huge future potential. But if you look at short-term valuations, overvalued.
Magda Wierzycka, founder of Sygnia, interesting Vacutech. You'd never guess who, well, I would never have guessed anyway, who the chairman of Vacutech is. Did you see, Justin, do you know? Have you ever watched The House of Cards?
I've heard it's a great series. I haven't watched it though.
Have you watched it, Stephen? The House of Cards. It's on Netflix. Anyway, well, if you've either watched it or you haven't, but your
kids have watched it, Stephen.
The star of House of Cards is the president's wife, the crooked president's wife, who herself becomes president, Claire Underwood, and she is played by Robin Wright. And Robin Wright is the chairperson of Vacutech. So they certainly have gone for star quality on that on that stock, on the one that IPO'd, as Justin said just a few days ago. Would you be buying what Magda says about it, remembering that this IPO'd on, what was it, the 2nd of May? Hasn't done much yet.
Yeah, so, clearly it's one of these companies that has blue sky potential, and I tend to be a bit risk averse. So, one wants to have a portion of your portfolio that would be exposed to these kind of investments. But as I said earlier, the first thing is, how much should I have in this category? And then where do I invest it? Do I go for one share? Or do I have a concentrated bet, or do I go for a portfolio? And, my view would rather be to be a little bit more cautious, go for that portfolio. So rather invest in a portfolio of these sort of companies rather than trying to pick the needle in the haystack, because it's just so hard to know. And also one of the problems with disruptive technologies is often they don't make money for many of the companies. If you go back in time to the railroads and all these, these fantastic inventions. Cars, there was, I can't remember how many, if it was over 500 car manufacturers, at the beginning of the 20th century, and only a few survived. And even today, they're not doing that well. So you've always got to differentiate between great technology, great businesses versus an actual great investment.
Stephen Nathan, our guest co-host here on a Tuesday night. And we're going to now move on to something similar, the strong rand, the powerful rand, the all-conquering rand, which got below 14 against the US dollar. Here is a short clip from an interview that Jackie Cameron had with Andre Cilliers of Treasury One.
This currency focus is proudly brought to you by Treasury One, South Africa's leading treasury solutions company that unlocks financial value for your business. Andre Cilliers is currency risk strategist at Treasury One. He joins me, Jackie Cameron of BizNews, to pick up on how the rand has been doing this week and where it's heading.
It's been below 14 this morning, and I think we will most probably see it going below 14 again this week. And I would not be surprised to see it moving into the direction of the 1380 levels. And I think then we will change our range trading that we have and move into a new range of 1380 to 1440. As long as the story remains of a buoyant commodity prices, low interest rates in America, and vaccines doing better throughout the world, and the economy starting to grow, we will see the dollar on the back foot, and we will see emerging markets do better. And the only thing that will change that is if we see significant demand coming from South Africa, and that would be only happening if we see manufacturing industry and so forth coming in and buying dollars, because they're actually expanding, building new stuff and building up the inventory levels. And inventory levels will only be built up if we see people spending, and the need for higher inventory levels is there because people are actually buying the goods and not just food and the little bit of clothing that they do at the moment.
Do you think that the rand could get even stronger later on this year then?
Well, we said last week that the rand is still in an undervalued area, and that still remains. And as long as we now actually do better on a fiscal side and tax collection looks better, and there's less pressure on the fiscal side to go and borrow more money, and they keep their spending under control, then that part of the story actually also starts positive. So yes, very much likely that the rand will remain in fairly strong territory for quite some time.
What do you see happening with the rand versus the British pound?
Well, the pound increases. If we see the dollar weakening and the pound increases, I think there's a very good chance that the pound could actually increase a little bit more in value than what the dollar actually weakens against the basket of currencies. So the pound could do better. And that's simply because I think the economy will start looking better. And I think the whole Brexit affair and situation is starting to look and playing out not too badly. And if the pound then gains more value, then we could see that the strong pound against the dollar could hold back on the rand actually gaining quite substantially on that as it would against the dollar. So we could see the cross rate of the pound actually weakening slightly. Not a lot, but slightly weakening bias to that side because of the pound actually doing better.
You've been listening to Andre Cilliers, currency risk strategist at Treasury One. For more of his insights, do head over to biznewsradio.com where you can hear the full interview. I'm Jackie Cameron for BizNews.
Indeed, there are lots of great interviews for you on biznewsradio.com. Just put that into your URL, into your browser, and it'll bring you to a particular page where you've got all of our podcasts, including the live feed. If you're not near your radio and you'd like to connect with us between 5:30 and 6:30 weekdays, you just stick that address into your phone, biznewsradio.com, and away you go. Just to remind you as well that Magda Wierzycka is one of our star keynote speakers at the BizNews Investment Conference. The first one that we had in March was fully booked very quickly. And this next one, which is at the end of August and the beginning of September, so August 31 to the 4th of September, 3rd of September, is already 3/4 full on the current regulations. And that's still 3 months away. So we're hoping that we'll be able to increase the number from 100, where the current cap is. But if we can't, and if you haven't booked early, you won't be able to attend, I'm afraid. So if you've got any interest in going to the BizNews Investment Conference, it's in the Drakensberg at the beautiful Champagne Sports Resort. And they really, really treat us royally there. Just go onto BizNews, look on the right-hand side of the homepage, and scroll down a little bit, and you'll see there's a link to the investment conference. Click on that. You'll get all the speakers who are in the conference, including Magda Wierzycka. And the great thing about this, because we're all in the Drakensberg, is that the presenters stick around for the full period. So you actually get to meet them, and there's your chance to shake Magda's hand if you think she's great, or you're not allowed to heckle, no chance. Adamus Stemmet is the spokesperson for the Association of Monitoring and Advocacy of Government Pensions. And before we bring Adamus in, Stephen, it's a very important field, and it's one that you know a heck of a lot about, retirement funds and pensions, and the Public Investment Commissioner, which looks after government pensions. Now, there's another scandal brewing around the PIC. It seems to have had a very, very turbulent time, and not surprisingly, pensioners like Adamus and the group are worried because their money is tied up in the PIC and will determine what kind of pension flow they get in the rest of their lives.
Yes, Eric, what's very interesting about the government pension is that it's the old style defined benefit. And really, what a defined benefit says is that there's a contractual obligation on behalf of government, the employer, to provide a pension based upon year service. So it's a whole formula. For every year service, you get a percent of your final salary. So let's say you work for 40 years, it might say you get 80% of your final salary, and it'll say that will grow by inflation every year. So it's a defined benefit, and in a bizarre or perverse way, the actual investment management has got nothing to do with a defined benefit. So as a member of the GEPF, as a government employee, what you would be worried about is if the government can't pay, and the government can print money. So unfortunately, the taxpayer should be more worried than the actual members of the government pension, because the taxpayers effectively are underwriting it. And what is being said is that, well, the government can just print money. In fact, there was an article, I think, today in the Business Day that basically said, well, one of the ways with a wage dispute, the public sector wage dispute, is to freeze pension fund contributions as a way of freeing up money for the government. Now that sounds absolutely bizarre to me, because really what you're doing is you are actually giving people that salary increase, because the defined benefit doesn't change unless they say we're going to give you less of a pension. So it'll be interesting to hear what specifically the concern is from the government pension side. I don't know if it's you might recall with Transnet, the Transnet pension fund, which is actually not part of the GEPF. It's a separate fund. There, the pensioners were worried about the pension increase. So because the fund did not perform, then they got a much lower to see what the specific concern is. And we know, the governance has been atrocious. I think would be the governance really has been atrocious. But as I say, fortunately, the lack of performance and performance because of the governance falls upon the South African taxpayer.
Adamus, Stephen Nathan, who's the founder of 10X and knows this field really well, has unpacked it for us. What then is your concern, or the concern of your organization?
The concern of our organization is, firstly, secrecy. We have secrecy from the government employees fund, the board of trustees, especially the PIC. Now, only yesterday, a new story broke in the newspapers about senior people of the PIC now are worried about the Isibaya investments, and we really do not know why they are worried. But we understand that perhaps they are worried because that they might lose their jobs. We are more concerned about the Isibaya investments. You know, Isibaya investments started off in 1995, and it was kept secret. Like most pension matters, GEPF matters are kept secret. Through the politicians, we forced the PIC to give full particulars to the Standing Committee on Finance. They were not very happy about the information they got. It was the first time that they got full particulars, but as Mr. David Manil said at that meeting, he was not sure that they gave all the information. Now, we are glad that if the staff now is putting forcing the PIC to come forward about the mandate. Now, I must say immediately that the mandate concerns all investments. That is a mandate by the GEPF Board of Trustees to the PIC.
Adamus, you're really not coming through well, I'm afraid. So I just wanted, if you can just keep your comments pretty short so that we can pick up on them. There is another scandal. You said that the Isibaya Fund, which is about a couple of billion rand, that invests in unlisted investments. Are you worried that that's been going to cadres and to people, in other words, being wasted and being your pension money being used by those who don't really have an intention to build a decent business?
All investments on behalf of the GFPF should, according to our pension law of 1996, be made firstly to sustain the fund and further to contribute to the growth of the fund. That is not always happening.
Okay.
At the meeting in the SCOF meeting on 18 October 2016, we had 65 out of 250 Isibaya investments underperforming and not even showing an IRR. In other words, a zero. And then there was losses up to 55, minus 55%. Now, regarding the mandate, we've been waiting now for years and years for this mandate to be reviewed. But of course, like the pension fund, everything about the pension fund is secret. In 2018, at the Party Commission, there was evidence that the GEPF outsourced the revision of the mandate to a private company. And they'd been working 2 years on it without completing it. The party was of the opinion that they could do it in two months' time, and they were instructed to complete it by 30 June 2020. Now,
Adamus, this is fascinating to you, and unfortunately for a broader audience, the issue that we're trying to get at here is whether or not you agree with Stephen Nathan to say that the governance has been atrocious at the PIC.
Yes, we do not trust the PIC at all, and we are also losing trust in the GEPF Board of Trustees very quickly, especially now after the President's statement about cadre deployment. The PIC is a government institution, and we cannot trust them at all. They are controlled by government, and we are sure that there are a lot of cadres deployed there. The same at the GEPF.
You've also been very vocal about the loan that was made, or the investment that was made, to Iqbal Surveys company, IO. Are you seeing any light at the end of that particular 4 billion rand tunnel?
Unfortunately not. I do not want to talk about the contents of the two cases. There are two cases. The one is for the insolvency of Secundialo. That's about independent media. And the other one about AO. Now, 2 years ago, the matter was taken to the Supreme Court. Nothing happened since. We've been asking questions. Journalists have been asking questions. Politicians have been asking questions. But everything is dead quiet. We are concerned that this matter will again be swept under the carpet as happened before. And I do not have to remind you about what happened at African Bank, where the fund lost 4 billion rand. There are lots of other cases where this happened. And if at the Party Commission, at SCOP, on the 19th of February last year, members of SCOP accused the GEPF of only learning about what was going wrong at the PIC through newspaper reports and by other parties, I suggest, like our GP.
Adamus, thank you for your contribution this evening. He represents government pensioners, and as you can hear, a pretty angry man.
Yeah, just with regards to that whole AO scandal, I just want to unpack further because I've got quite a decent understanding of what happened there. Basically, they went to the PIC with this valuation. They valued the company at 15 billion. The PIC put in 4 billion, which was essentially just under a 40% stake in the business. And basically what they are doing with that money now is they're feeding it into all the subsidiaries. Or sorry, AO is a subsidiary of AEI, which is African Equity Media.
The old Secundialo.
Yes, the old Secundialo. And that money is essentially just funding dividends into the parent company, AEI, the old Secundialo, and AO. So, yeah.
So the pensioners' money is going down a pit, and unlikely, certainly from what Adamus has been writing and talking about, to ever be recoupable. It doesn't sound very good, Stephen. You said the governance is atrocious. I guess that's one branch of it.
Yeah, it's very, it's very sad and very concerning and very disappointing because, a lot of people have picked up on this, the journalists have picked up on this, and even at the time, at the AO listing, I mean, it was well publicized that it was inflated, by a factor of 5 or 10, so it wasn't, this isn't a valuation dispute that it's a marginal, is it 20 or 30%? It's a factor of 10 times. And the fact that there's no accountability, and the trustees must take responsibility. Ultimately, the trustees of a pension fund have a fiduciary duty to the fund, to the members of the fund. So they legally they should be apolitical. They should not be influenced in any way whatsoever. There's a fiduciary duty. You owe that. But clearly that isn't happening, and there is no accountability. But the government employees pension fund, the GEPF, it's a law unto itself. Literally, it's not governed by the Pension Fund Act. So when we talk about Reg 28 and all of those constraints, it's not governed by that. So that's what I'm trying to get across. It's this enormous liability that the country and the taxpayers carry on behalf of government, and with the lack of transparency and accountability and the shenanigans that are so blatantly out there, that is concerning, and that should definitely be under the president's remit of cleaning up the governance, the accountability. That's a really big place to start with 2 trillion rand of assets.
The president only a couple of weeks ago in his weekly letter praised investigative journalists. I wonder if he's going to take some tips from them regarding the whole story with AO. But we thank Adamus for giving us his point of view. Well, let's get on to that undergreed story now, which my colleague Nadia Swart put together for us.
Degreeless jobs are in demand. That's according to this interesting podcast by our partners at Bloomberg. Reporters Matt Miller and Kaylee Lanes discuss job demand with the co-founder of Adzuna, Andrew Hunter.
All right, let's get over right now to Andrew Hunter. He's the co-founder of Adzuna. I told you, everyone knows how desperate companies are for workers. I saw a story yesterday that the governor of Montana is giving people $1,500 stipends if they'll just come back to work for like 4 weeks. Andrew is the co-founder and economist at Adzuna, which is a job search engine. So, Andrew, how dire is the situation here that we're seeing states all over the place do everything they can to get people to stop, whatever they're doing at home and come back to actually working in a job?
Hi, Matt, and a real pleasure to be on the show. Yeah, absolutely right. So what we're seeing in the US at the moment is hiring levels at 15% above February 2020, so pre-pandemic levels. So the job ad inventory is there. Folks are getting back to work and hiring, but luring in those candidates is proving to be increasingly difficult in specific sectors, but also specific states all around the country. What we're seeing at Adzuna is booming hiring in healthcare and nursing, in logistics and warehouse, and in construction and manufacturing. Those are the three sectors where we're seeing double-digit percentage increases year on year in activity. But yeah, as you say, the challenge is getting folks into those jobs fast and giving them the confidence to return to work.
And in those sectors that are hiring the most right now, many of them are jobs that don't require a college degree. What's driving that bounce back?
So if you think about the last 12 to 14 months and the way that the economy's shifted towards this e-commerce boom, at-home economy where delivery and logistics and warehouses are becoming increasingly important to the heartbeat of the economy, that's where such a huge amount of this job creation is occurring. And many of those roles are accessible to folks without a degree. So what we did at Adzuna is we indexed about 4 million job vacancies from the last 2 months and looked at those roles that did not specifically say we require a degree. And it was well over half of the vacancies where that wasn't a stipulation. So that should give some optimism to those that aren't educated up to a college level. And I think the other point to make is you don't have to be Mark Zuckerberg to work at a technology company. So,
isn't that an interesting clip there, Stephen? We had on our premium newsletter this morning information from the Wall Street Journal that Joe Biden is allowing in entrepreneurs from all over the world. He's reversed something that Donald Trump had. As long as you've got a business that you can put $250,000, which is not a heck of a lot. It's about, under 5 million Rand, and $250,000, and you employ 10 people, they will give you residency for 5 years. So entrepreneurs are being attracted by the US. They're creating jobs, not just for college or for graduates, university graduates. It seems like the world of work is becoming a very interesting place, particularly in this biggest economy in the world.
Yes, the US, they are amazing. They get themselves into trouble quite quickly, but they certainly get themselves out of trouble faster than anyone. So you really have to admire that. And the unemployment rate, it's quite exceptional to think that it would. I think it's 6.1%, something like that. It really is an amazing economy, and it's also good to see that people who don't have degrees can get jobs, because it wasn't very long ago we were concerned that robots were going to take away all these jobs. And if you look at jobs like warehouses and logistics, you actually worried that there was going to be a shortage of jobs available. And now it seems as if there's a shortage of candidates. So that's really interesting. And also along those lines, Alec, you may have seen that Google is also now starting to hire people that don't have jobs, and these are for technical jobs that they say they can train you in 6 months. They can train you and equip you to be, you're not going to be a high-end software engineer, but certainly to kind of, be technically proficient in that. So it's quite amazing the innovation that takes place in the US at all levels.
And to the desire to bring in entrepreneurs from all over the world to help them with their employment situation. Well, BrightRock believes that with every change in life comes opportunity, and the markets aren't any different. The daily movements in the markets mean change for us all, sometimes small, sometimes big. This daily market report is made just for you by BrightRock, the first ever needs-matched life insurance that changes as your life changes. Here's Justin.
The JSE All Share Index was a bloodbath today, sharply low at 67,300. NASP was down 2% to 200 Rand a share, as Tencent was weaker in Hong Kong this morning. Prosus down 3.3% to a touch over 1,400 Rand a share. The share is nearly 30% off its highs and into deep bear market territory. Vronim and Sybanya Stillwater lost 4% to 65 Rand a share, as the positive Q1 update is simply a distant memory. Harmony shed 5.5% to 68 Rand, as even safe haven commodities were sold off today. And lastly, Hyprop lost 5% to 28 Rand a share, as the company announced an accelerated book build, which raised approximately 360 million Rand. In the currency markets, the Rand was flat against all the major currencies to 14 Rand to the dollar, 19 Rand 80 to the pound, and 17 Rand 03 to the euro. Gold is steady at $1,829 an ounce. Brent crude is flat at $68.40 a barrel, and the premier cryptocurrency will put you back 780,000 Rand a Bitcoin.
780,000, long way from 900 and what thousand. But anyway, just beware. This market report was made just for you by BrightRock, the first ever needs match life insurance that changes as your life changes. And just to remind you, we've got another 12J webinar on BizNews tomorrow at noon. Geltek's Jonty Sachs and Gaurav Nair will unpack the appeal of the top performing 12J investment for 2019 and 2020. If you don't know what 12J is, it is a tax incentive benefit that government is doing away with at the end of June. So if you've got a tax problem, if you're earning 125,000 Rand a month or more, you definitely have a tax problem. That's when you're paying over 45% of your income in tax. If you invest through it into a pre-qualifying 12J company, and Jonty and Gaurav have got opportunities to discuss there, then you can write the full 45% of your salary back against your income tax. So actually, what happens is the taxman pays half the investment. It's a fantastic investment, so good that that's why they're doing away with it. Treasury has actually cancelled it from the 30th of June. There's a webinar at noon tomorrow. If you want to attend, it is free, but you have to register. Go on to biznews.com, look down the right-hand side, and you'll see that there is a registration button. Well, that's it from us for this Tuesday evening. We look forward to being back to you on Wednesday, which is tomorrow at 5:30. And remember, you can get us on FMR in Cape Town, free to air, of course, on biznewsradio.com, anywhere in the world. And for a little bit of fun, go onto the BizNews TV YouTube channel, subscribe to it, and we'll tip you off every time BizNews Power Hour is coming on air. From our guest co-host, Stephen Nathan, from sound engineer, Dudu Masuku, and of course, Justin Rowe Roberts, and myself, Alec Hogg. It's been our pleasure. We'll be back in your company again tomorrow. Until then, cheerio. You've been listening to the Power Hour, brought to you by the team at BizNews.
Cheers, Alec.
Are you still there, Stephen? There was a question I never got around to, and there's quite a few people still listening on YouTube.
The Old Mutual one.
We didn't get to the Old Mutual one.
Old Mutual one.
And we didn't get to one about share buybacks. Maybe on the Old Mutual one, because we are recording, we can record this. Do you want to just record this, Dudu? And just record it. What do you make of that story with basically what Justin, what one of our listeners said was that she invested in Old Mutual, I think at the time of demutualization, which was, it was in the late 90s, and it was 11 Rand a share. And today it's 11 Rand a share.
Yeah, but they have unbundled some parts of the business.
Bit of Nedbank. That's it. Have they unbundled anything else, Stephen? Do you know?
Yes, so there was Quilter.
Yeah,
there was
a big
Quilter.
one.
Okay.
Quilter was big.
So you should add Quilter and Nedbank on what you got for those shares. Maybe what's happened with our listener is that she hasn't been informed about those unbundling. So the shares could be sitting there, not that she should actually claim.
Yes, it does seem. Sorry. Sorry, Alec.
No problem. We're keeping you longer than usual.
No, I just had my daughter ringing the bell. But so you may recall there was an article in 2018 done where it kind of compared Sanlam versus Old Mutual because they demutualized within a year of each other. And, the analysis there showed that Sanlam had returned 2,000%, which means it went up 20 times. And Old Mutual's return was 480%. So it had gone up just under 5 times. So Sanlam outperformed by a factor of 4 over almost 20 years. So, Old Mutual has been a big underperformer, but maybe not as bad as people would think because, if you just compare the share price, it listed, I think, at about 6 Rand in 99. Today it's 11, 12 Rand. So over 22 years, that's not a great return. In fact, that's a very poor return. Your money would have done better in the bank, even with Absa's money market fund. It would have done better. You are missing those unbundlings. But it's been, it has been a really big underperformer. And, I remember that well, Ali, because I was an analyst in those days. And, when Old Mutual demutualized, you'll recall that the late Mike Levette was the chairman, and they went from a mutual company, which is not a for-profit company. It's not you don't have shareholders to answer to. So they had a big leap going from a mutual company to a publicly traded company where you have shareholders and you're far more accountable to that. But I think, what Old Mutual said at the time is that we're too big for South Africa. If you remember that, we're too big for South Africa. In fact, Trevor Manuel at the time, which is actually quite ironic because he was the Minister of Finance, he had to give special permission for them to have a primary listing in London because they were going to externalize capital, who now Trevor Manuel's actually the chairman of Old Mutual. So they've come full circle there. But I think what Old Mutual, they were wrong strategically because they felt that they were too big for South Africa. They'd done all they could in South Africa, and their future growth was coming offshore. So they took their eye off the South African ball, which Sanlam and Discovery and others, didn't. So they lost enormous and brand value in South Africa. And then they went offshore and they made some pretty disastrous acquisitions. I mean, they bought United Asset Management in 2000 for $1.5 billion. And United Asset Management, even at the time, I remember there was an institutional investor article exactly at the same time that Old Mutual bought, saying that United UAM was not a great asset manager. Then they bought Sygnia, I think in 2005, and they paid 38 billion Rand for Sygnia. And Scandia's market capitalization was bigger than Sanlam's. So they actually could have just bought Sanlam. Can you imagine that? They could have bought competition commission stuff aside. So, they really took their eye off the ball. And unfortunately, the irony is that their best performing offshore asset, being Quilter, which is a financial advice asset gathering business in the UK that they unbundled, has actually done really well. But they've actually given that away. So, there's really been lots and lots of missteps from Sanlam, and it's not really
from
apparent.
Old Mutual, not Sanlam.
I beg your pardon. From Old Mutual, and it isn't apparent, what they're going to be doing differently going forward. I'm sure they have a strategy, but I don't think it's apparent to the market yet. That the future is going to be much better than the past has been.
And then they also had that fracas with Peter Moyer, which wouldn't have helped internal sentiment either. There was another question that Andrew Lake posed. He said, can you explain this morning's comment in the newsletter that one of the leading indicators of a share price's future is the action of company insiders? What I was trying to say there was that as a founder of a business myself, when the company was listed, I bought shares when they were being thrown at me and very cheap. And then I certainly didn't buy more when the stock was expensive. And it's because the founders of businesses actually understand the businesses and the true valuations. Well, they should, better than most outsiders. And the point I was making there was just watch out, because there's been some hefty sales by both Jeff Bezos and Zuckerberg, whereas Elon Musk, bless him, and who was the other one? Well, he hasn't sold a share, and very small sales by Microsoft. But then again, Microsoft's not the founder. And my point that I was trying to make was that if you follow what the founders are doing, on buying or selling shares, it's usually a good indicator on whether it's time for you to be buying or selling the same stock. That was really the whole thing. Do you agree with that?
Yeah, 100%, Alec. I mean, there's a reason why stock markets all around the world require insiders to publicly disclose their trading activities. Not just the founder, but if you're a director, if you're in a privileged position, and you're an insider in a company, you are obliged to publicize that because it has huge informational value. We want to know what the insiders are doing, and it's also it's the chef eating his own food. Are they saying what a great company it is, but they're actually selling down their holdings. So in general, insiders have access to information that an outsider doesn't, and that gives them an unfair advantage. And as you say, a founder who knows the business from the bottom up, has the most unfair advantage of all. It doesn't always work because it doesn't always, it's not 100% correlation that when the founder sells, it's time to sell. But the correlation would be pretty high. The exception would be when a founder gets emotionally, too close to a business and doesn't see, the reality. And we've seen an example of that. I mean, I've seen, founder businesses in South Africa. If I look at, and as an example, Liberty Life, Johnny Gordon, does a phenomenal job. And at some point, they start to kind of get it wrong. So that would be, a time where they don't get it right. So they don't always get it right, but certainly, I would more often than not follow what the founder is doing.
Stephen, thank you. And thanks for staying on a little longer with us tonight.
Thank you so much,
We'll
Alec.
catch up. It's lovely having you on the show, and we'll see you on Tuesday.
Thank you so much.
Okay.
Bye-bye.
Bye, Stephen.
Cheers, Stephen.
Bye-bye.
Bye-bye.
Okay. Thanks, guys.